Well, good morning, everyone, and welcome to day 3 in our week-long series of webinars called Tidying Up the Tax Year and Beyond. My name is Mark Bramwich. I'm Director General of the Enterprise Investment Scheme Association, or ESA, as we're better known. We're a trade body for the EIS and the SEIS industry. So look, as I say, this is day 3. If you missed day 1 and day 2, they are available on our website. We do have recordings of them, and you missed 2 crackers because we have Building Back Better on Monday, which looked at kind of the UK economy, what's happening with the economy, what's happening with COVID, what's happening with Brexit and all those popular things. So hopefully, if you can pick that one up, it's well worth a listen for that one. Similarly, day 2 yesterday, we had ones to watch, fund managers to watch for 2021, kind of looking at the new kids on the block and seeing some new fund managers that you might not have recognized before. So again, that's available on the website. Go and have a look at that one. Which brings us very neatly on to day 3, because day 3 is all about ESG. So it's all things ESG and related to it. We had Earth Day last week, so it's a prescient time to run this one. But yeah, as we all know, ESG is fast becoming a mainstream area of investment. But what are the implications to your clients, and what does it mean in an EIS and SEIS sense? So this webinar is going to dig a little bit deeper into the world of ESG, to help you understand the concepts of ESG or social impact or sustainable investing. It's got a number of names, and we'll talk about that as we go through. But certainly many fund managers are starting to create offerings specifically into this area. So it's important you as advisors, financial advisors, financial planners, I should say, understand these themes and how they relate to your clients, because many of them are developing a strong interest in this area. And of course, ESG stands for environmental, social impact and governance. So we already heard from Boris Johnson on the environmental side. He wants to accelerate the UK's efforts towards net zero emissions by 2030. So there's a lot to talk about on that side. Social economic impact has been brought up more to the fore by the coronavirus pandemic and what's happened there. And obviously we all know we're trying to increase our diversity issues, et cetera, et cetera. So again, lots of things we can pick up on that side of it. And then finally, the G, the governance side of it. You know, EIS companies, EIS portfolios are dealing with startups and young small companies who have boards. How do they structure their boards? How can they put those boards together? How can they make boards as a governance effective as possible? All of those things and more we will cover off today. Agenda-wise, we have an hour, so we've done by 11. We will get you out of the house, as it were, by 11 o'clock. Absolutely. If you have any questions, please do send them through on the Q&A or the chat. It's down the bottom there. I'm sure you know by now. We've been way too long on Zoom, so I'm sure you know how to use these things. So please use that and follow those through, because it's always useful to have good questions come through. And apart from that, as there's no physical element to this, there's no need to tell you where the fire exits are, et cetera, et cetera. I'm sure you know where you are in your own house, and then just deal with that. So it leaves to just leaves me to introduce people on the panel. So ladies first, Lisa, would you like to go first?
Hi, thanks, Mark. Hi, I'm Lisa Matthews. I'm Portfolio Manager at Jensen Funding Partners. We are an SEIS and EIS investment fund. We've been operating over 8 years. We've made 110 investments and approximately £18 million invested in UK startups through SEIS and EIS structures. We are a fairly generalist fund, so we invest across all kinds of different sectors and businesses, all at that same SEIS and EIS stage. And my job in the fund as portfolio manager is in supporting all the companies in our portfolio, our investees. So monitoring and reporting to our investors on what they're doing, but also helping where the fund can to build value in those companies and support them with their challenges. And particularly with early stage companies, a lot of that is around the ESG factors and particularly governance, because these are quite early stage companies, and getting those foundations right is where we like to focus as a fund.
Brilliant. Thank you very much. Michael, would you like to go next?
Okay, yeah. Michael Usher, I'm head of PK Wealth. We're a discretionary investment management business, so we construct and manage portfolios around active, passive and ESG as our core strategies. So it's looking at the market, obviously generating information around that, looking at risk, in particular risk management, a particularly important area in this field, and pulling that information together, building portfolios, delivering that information back to clients.
Thank you very much. Max, over to you.
Sure. Hi, I'm Max Middleton. I'm an investment manager at Vala Capital, which is the appointed investment advisor to both the Vala EIS portfolio and also the Vala Sustainable Growth EIS Fund, which is a newly launched fund focused on early stage investments into EIS qualifying businesses that are building products and solutions for a more sustainable future. And I'm looking forward to talking about how that's a little bit different or where that overlaps with ESG considerations.
Brilliant. Thanks very much. And last but not least, Steve, over to you.
Morning, Mark. Thank you. Yeah, my name's Steve Dobson. I'm head of investment at Growth Invest. For those that don't know, Growth Invest is a platform very much targeted at the advisor planner market for alternative investments, tax efficient investments. So we try and take a broad whole of market approach across VCT, EIS, IHT, and some non-tax efficient products, anything in the alternative space, allowing basic advisors to import any legacy historical portfolios of their clients onto the platform, also to execute digitally any new investments, and then be able to consolidate everything in one place and have a one-stop shop to view all of their investors' holdings. So we kind of sit between the funds and the advisors themselves.
Sure, lovely job. So we have our panel. So as you can see, four experts, because I'm not an expert on ESG, but 4 experts on ESG and the topics we're going to talk about today. So it's probably worth starting from the top, as it were, and saying, what do you believe is meant by the term ESG? It seems to mean a lot of things to a lot of different people. So Max, do you want to go first on that one?
Sure, happy to. ESG is a term that has an interesting history, I think. It's been around for a while, originally emerged in the early 2000s, but it's really come into the spotlight in the last few years, supplanting terms like corporate responsibility or SRI in the financial sector's conscious capitalism lexicon. So it's become really big in the world of investing writ large, and as a result, in the world of corporates, and in a very short period of time and in a way that we haven't really seen before. So ESG is important now to pretty much any corporate and any investor. So what is it? Basically, it refers to 3 separate categories, as Mark referred to earlier: environmental, social, and governance, upon which you can score a company, fund, or any asset. And within that, there are a number of subcategories. So within environmental, you're talking about carbon emissions, of course, but also waste management, biodiversity impact, air and water pollution. Social, you're talking about things like gender diversity, human rights standards, labor standards, employee engagement. Some will even include customer satisfaction in that category. And then governance, where you're talking about things like board composition, executive composition, bribery, corruption policies, et cetera. And when you take all of these disparate categories together and lump them together to measure performance against these characteristics, you get ESG. And the basic thesis is that good ESG metrics should result in better risk-adjusted performance than if you just considered financial metrics alone, because these are areas which, while not directly feeding into profitability, create the foundations for sustained success and profitability. So advocates of ESG will say that this is tied to a very real, tangible financial benefit. And there's a gigantic pot of money behind this now. So according to recent Morningstar report, proactive ESG funds that are specifically trying to optimize or improve those ESG scores in their portfolios account for over $1 trillion in assets under management. Those that have negative exclusionary criteria, so ruling out bad ESG performers, are closer to 30 trillion. And there's 80 trillion in AUM that's committed to integration with ESG principles in the future. So this is a lot of money. You really cannot afford to not have an ESG strategy if you are a company. You need to understand what it is. You need to understand how you're scoring against it. And while this is principally a concern for later stages of capital formation in public markets or later stage private equity, younger companies and early stage investors need to be aware of this because it will become increasingly important as they mature. And it's easier to have these things in place and grow with it upfront rather than trying to retrofit it at a later date when it's really critical. And probably the last piece to add to it is that there's a whole slew of reporting standards and frameworks which comprise part of the lexicon of this ESG universe. So some of those that you probably have heard of are like the principles of responsible investing, or PRI. There's the Global Reporting Initiative, GRI, but all of these are really trying to get to these aspects of the business that aren't directly related to financial performance, but are of intrinsic value to the business and are trying to capture that other dimension.
Sure, I had to suppress a laugh there when you were talking about governance and talking about bribery and conflicts of interest. Because all I could think about was our government at the moment, but it seems to be engulfing them at the moment. But Michael, Max gave us a very full and comprehensive answer there. Was there anything you would add to what we mean by the term ESG?
Yeah, I mean, I think the key thing in the environmental section is climate change, and obviously social is about people in the workplace, and governance about better management of companies. But I think the acronym itself sort of sets off alarm bells now. There's an urgency about that acronym. And it's about the fact that we've been through the sort of awareness phase, we've been through the education phase, or we're in the education phase, but we're right at the sort of action stages now, where companies are are much more accountable. They've got to come up with plans. They're measured against targets, and the realization of all of that is very real. So I think it's sort of continuing the process of capital flows around that to influence those change. But I think ESG is all about the actual elements of the acronym, but it's more about an urgency and a need to get on with all of these issues.
Sure. And advisors you work with, are they seeing more interest in this area? Are the clients seeing more interest in this area? Is it becoming a bit of a hot topic?
Yeah, no, definitely. I think certainly as far as clients are concerned, they're sort of picking up on, I mean, things like on the TV, recently we had Greta Thunberg, sort of going through the whole process and various other programs. So the awareness is out there. Investors are therefore becoming interested in the sector. Clearly, there's a lot of new innovation out there. Advisors, financial planners are having to engage with that. They're actually having to ask questions of clients now to find out what their preferences are at the end of the day. And then they're sort of having to come into the research world and start sort of sorting through the sort of what is still a fairly sort of opaque process to try and sort of come up with some solutions for clients. I mean, that's where we sort of come in, if you like. We're working with advisors. We have risk profiles. We have a view on risk in the sector and a view on how to represent the themes, the underlying themes in portfolios, and working closely with them to deliver those outcomes.
Sure. And I remember when I used to be an advisor, I'm thinking back a number of years ago, Max picked up on a little bit in terms of the lexicon of all this stuff that we used to have green portfolios and ethical portfolios back in those days. Is what we're seeing now, Lisa, is this kind of the evolution of all of that? Is this where we're at now?
I think absolutely. I think it's an important point to note that we're not just talking about businesses who have impact as part of their mission. So it's not the term isn't only referring to companies that you'd look at and have a clear mission that is to do with climate change or social or public good outcome. This applies to all business that plans to or wants to grow and build a sustainable future for itself. We see this as and I echo Michael's point there. This is now a very practical era of implementation and tactics and how we go about doing business at a very operational level that is responsible, and that where we're mindful of managing and mitigating the impact that business has on people and on the planet, and that cuts across all businesses, whether or not you explicitly have a kind of impact goal.
So is there a distinct difference between a company that is setting up purposefully to be meeting ESG governance and the kind of worrying about that first before profit, as opposed to a company that's setting itself up for profit but kind of adding in some ESG bits and bobs just to tick the boxes?
Well, I think ultimately it's going to come down to which is the strategy that's likely to succeed there. And as we see, the landscape that companies have to navigate through to grow, consumer trends, investor trends, and policy trends are the things that are really driving the risks those companies are managing. And so if you really want to plan for, building sustainable value in your company, the direction of travel in those sectors are what's going to impact your ability to do that. And I think that, increasingly people who are building are exploiting opportunities and are building long-term value will, short-term thinking is not going to get them there. And actually the earlier you can think about these issues in the company at the early stage of the company and embed good responsible practices, the easier it's going to be to navigate those landscapes. And as we all know, you know, there are a lot of legacy issues in older companies, and the challenges of trying to retrofit good practice into those situations is, you know, pretty much an uphill struggle.
Yeah, I can well imagine. Yeah, and Steve, just coming to you finally. Sorry to leave you to last. We mentioned ESG so far, and I mentioned at the top that quite a few EIS and SEIS funds are kind of entering this arena, and they're all kind of labeling themselves differently. Some call them ESG funds, some call themselves social impact funds, some call themselves sustainable investing. Again, is there any difference, or is it just a kind of a different lexicon?
Yeah, I think, you know, they come under the ESG umbrella, I guess. We've seen over the course of the last year, 2 years, more funds coming into this space, whether it be a brand new fund or whether it be a more established fund manager, and is coming out with a very targeted, be it sustainable, be it as carbon focus, zero carbon focus on the fund itself. And I think this is where it gets a little bit more complicated for the advisor world, purely because it is so broad. ESG, you know, Max, and I think everyone's alluded to this, it's such a broad topic. And, you know, what is important to the end investor? Is it the environment? Is it the social aspects? Is it the governance piece? And we've kind of seen over time, you know, there's been a big focus on governance from post the financial crisis, you know, the social impact on the in the environment. But then what seems to be the focus at the moment, and again, Michael alluded to this, is the news is very much talking about the real climate crisis is out there at the moment. And I think end investors can more associate with that than any other aspect of the ESG umbrella. And I think that's why you probably see more focus in that area. And I think we'll see, you know, a bigger growth. It's getting the message across. And, you know, a lot of it is collaboration between the different parts of the industry, be it the trade bodies, be it the platforms, be it the fund managers, the advisors themselves, and bridging that information gap to make sure that, you know, MiFID has enforced advisors to think about ESG as part of their discussions with their end investors. And, you know, it's like, because it's so broad, we need to help inform and bridge that information gap, as I say, between the funds and the advisors themselves, to make sure that, you know, they know exactly what is available out there, because the tax efficient space does provide a solution now for the ESG conundrum, whereas before, I think previously advisors would look away from the tax efficient space.
Sure. And then call me a cynic, and apologies to the fund managers on the call, but is this fund managers just jumping on a bandwagon and seeing this as a bit of a fad, or do they actually have the credentials to take all this stuff forward?
Is it a fad? Absolutely not. I think the reason we're here today, you know, supports the fact that this is a long-term investment strategy and this is here to stay. You know, more and more, I've come from the institutional world, and ESG has been an acronym that's been banded around for a long time, but it's still relatively new. It's very new in the retail space and the tax efficient space, but I think we're going to see it growing. As you say, we're seeing more funds come into this space. I think we've got to be careful about the greenwashing side, and I think what's going to help ultimately in this is a framework. There's lots of metrics out there at the moment, but, you know, as we know with ratings agencies, you know, very, you know, the same product can be rated very differently. So we've got to work together, collaborate on this to come up with a framework that can help from the fund perspective and through to the advisor, so they really know what they're investing in and they can fulfill their obligations to the end investor.
Sure. I guess I should give a right to reply there to the two fund managers in terms of Max and Lisa here. So Lisa, look, I know Jensen have a generalist fund, but why are you kind of tipping your toe in the water of ESG?
Well, it's a good question. And whilst we don't have a specific impact investment thesis, when you look across the portfolio, we have about 1 in 6 of our investee companies that actually have an explicit positive impact mission that they're on. And then that's, you know, and we haven't selected them specifically because we are trying to secure investments in impact-driven businesses. It's because we've seen those opportunities, and, you know, they have a credible plan to do good and build a valuable business at the same time, and which ultimately creates value for their customers and value for our investors. And so, whilst it's not an explicit thesis, I think naturally, if you operate and along the values of responsible investing, you will end up with a portfolio that obviously covers both the impact-driven businesses and also other companies who, whilst their product or their service isn't obviously about public good outcome, the way they go about their business clearly is to the benefit of all their stakeholders in a managed way. I think it's important to say, obviously, that the perfect business doesn't exist, and one framework to measure everybody you'll always find businesses in particular sectors or models that don't quite fit into those. And so I think it's the approach we try to take is very principles driven, but very bespoke to the particular opportunity we're looking at. Okay, which are the dimensions of ESG for the stage of this company now that are significant and important? Which are the ones that are likely to be in the future? And we will try and adapt the way we are assessing that company and the way we are working with that company to suit their particular circumstances, underpinned by the values of responsible, sustainable business growth.
Okay, so I guess when you're looking at hundreds of companies and who you're going to choose in your portfolio, so when you're doing your filtering or your screening process, how much credence or how much kind of bias you put on this company is meeting some of those ESG principles?
I can't put a figure on, we don't have a sort of it's 30% this, 20% that, etc. But it's in there in the mix in our screening questionnaires, and particularly, because ultimately that screening point is about identifying opportunities and it's about identifying risks, and companies that potentially have negative ESG impacts, that's clearly a risk to their ability to grow and to do business and to deliver value to our investors. So it's weighted alongside the founding team, the scale of the market, all those other kind of factors. I think the important thing is that it is in there in the mix, and all the way through our process, not just from the screening but also at our final investment committee stage. The ESG factors are considered and noted in that evaluation, on the table with all the other factors you'd expect to see.
So no sex, drugs, and rock and roll investments these days. It's all gone past that, I guess. Really. Max, I should ask the same question to you, because you have gone that way, I guess. Because Vala do have a kind of, for want of a better phrase, a normal fund, and you have your social impact fund as well. So why have you specifically set up a fund for this area?
Well, we don't consider any of our funds normal, Mark. So
thank you for the correction.
Throw that out there. So I think probably, first of all, just acknowledge that these are not fully settled terms, and I'm sure you'll find as many definitions of sustainability or impact or ESG as you will investors that align with those principles. But I can share how we think about it at Vala and why we're bullish on the space. So to begin with, I should set out that we're not describing ourselves explicitly as an ESG fund, because ESG has become tied up with a whole lot of frameworks and reporting standards that are primarily associated with later stages of capital formation, which we think are important, but are not capturing the outputs that we are trying to achieve with this fund. So what we're talking about instead is sustainability, which certainly overlaps, but does not necessarily neatly track to the various ESG frameworks that we've talked about. So basically, we're starting with the premise that we're currently facing a huge set of challenges as a species and society. The world is getting hotter, more crowded, more resource strained, and while inequalities persist or in many cases grow. And we believe also that there's a collective survival instinct that's begun to kick in, which I think we've all alluded to earlier, from boardrooms to kitchen tables, which is recognizing that there is a moral and practical imperative to change the way we do business. And businesses that align themselves with this push will be at an advantage to those that don't. And the reason for that is many, but basically it boils down to these companies having preferential access to customers, talent, and capital. And when thinking about what qualifies as sustainable, we refer to the UN SDGs as our North Star. So we're not trying to reinvent the wheel, but we, in our investment thesis, have attempted to boil this down to 3 key themes that we believe capture the breadth of the mission, while also allowing us to focus on areas where there are venture grade opportunities. And so we've identified those as technology for planetary health, sustainable commerce and consumption, and democratizing access to societal needs. So we're not looking for companies that are just trying to optimize an ESG score. Rather, we're looking for founders and businesses that are actively trying to build solutions for a more sustainable future. And that's what we mean by sustainability-focused investing, investing in companies that are building those solutions that are driving us towards a sustainable future, and which we expect will see superior returns due to that alignment with the urgency of the moment. And then I think the other category you mentioned was impact investing. I think impact investing can sometimes denote that the impact of the investment is being prioritized or considered separately to the financial return. And again, I would caveat that this is not meant to speak on behalf of the impact fund managers out there, but for us, we are looking at businesses where we think that the performance is actually going to be, the financial performance is actually going to be enhanced because the businesses are active in building solutions for a more sustainable future.
Great, thank you very much. We had a question that came in through while you're talking there, Max. I'll perhaps pose it to Michael. Has ESG taken over from ethical investing, and is there a difference, Michael?
Well, I think ethical investing is part of ESG, and in fact, it's as far as we view it at the end of the day, there are sort of three parts to it, and sort of ethical almost is the sort of start point, which you can sort of deal with via a sort of positive or negative screening approach. So you can actually sort of screen out, if you like, the worst offenders, if you like, in the field of armaments and gambling, etc. You can do that on either a negative screening basis or a positive screening basis. So I think that's the foundations, if you like, of where all this came from at the end of the day, sort of back in the mid 80s with sort of Friends Provident, etc. That's where it all started. But going on from that and sort of building into the second phase, which is a sort of sustainable phrase, and some overlap here with what Max was saying. Really, that's about the longer term. So the screening out as an immediate process. The sustainable approach is more about the long term. So it's engaging with companies, trying to change ideas, integrating ESG approaches into those companies and changing the direction. And obviously working with certain companies which don't score that well in the ESG space. But you've got to take those problems head on, in order to help those businesses change to make the difference in the future. And then the third part of that, as we said, are the impact oriented companies. So these are, sort of tend to be smaller companies focusing on sort of clean energy solutions, green technology. They're sort of trying to, they're providing the solutions for the world problems now, and making an impact now in that space. So blending those three stars together, produces very different risk outcomes at the end of the day. So you need a risk overlay on the top, which we do through the process of portfolio optimization. So you take your asset groups, you back test, you come up with volatility ranges, you come up with asset allocation ranges, and that gives you control, in the sector, because, if you go down the route of having, impact portfolios representing, impact companies, if you like, representing the majority of your portfolio, then you've got a lot of sort of small tech companies in there and a hell of a lot of volatility. And, you may be very much engaged with what those companies are doing, but if you then suffer a 50% drawdown in the value of your portfolio, then you've got a problem. So I think you've got to fit these pieces into the risk framework. And then sort of manage it out from there. Once you've done that, what is the output on growth and value in your portfolio? What is the output at the sector level? What exposure have you got to utilities, to basic materials, to energy? They should be in the low digits. Your exposure to health, to technology, probably the financials, which sits in the middle. I mean, you can't control what banks are doing exclusively. There's some loans going in the wrong direction, there's some loans going in the right direction, but those sort of sectors should be sort of mid-teens exposure in your portfolio. And you bring the whole thing together through that sort of risk management process to sort of do well, but gain a return as well, a competitive return within a risk-adjusted framework.
Yeah, most investors like to get a competitive return at some point, don't they? Absolutely. And Steve, Michael mentioned the kind of risk frameworks and asset allocation there, and obviously, that can be done for a pension, for an ISA, through different vehicles. Does EIS and SEIS lend itself as an ESG vehicle in that sense?
I think it does really well, because it's about investing, and investing is very much for the long term. And if you think about an EIS product, you've got to hold it for 3 years for the tax relief, but also you're looking really for a 5-8 year horizon on these investments. Now, people invest to make returns. I think historically people erred away from ESG or sustainability because they didn't think they could deliver the returns required. But as mentioned already, having a good ESG policy actually drives towards potentially cheaper capital, leading to better returns for these companies. So when you think about it, given coming out of the COVID crisis, the government's got a policy for this green revolution, industrial revolution going forward to build out of this. The EIS and the SEIS sectors are actually prime for this, because you're buying into British businesses with good tax relief, but also, you're doing it for the right reasons, for the long-term impact that these companies can have. A lot of investment has been done historically based on last quarter's financials. Here you're looking beyond just the financials themselves. You're looking at other aspects, non-financial aspects of the company's performance, and building that into your portfolio selection. So, EIS, going back to your question, I think it's prime for this, because there's a lot of businesses. The problem is huge out there, this climate crisis and the environmental crisis. There's no one company that can solve this. This is going to take coordination among many companies, governments, and big corporates as well. So where it can be helped from the basics, and from the grassroots upwards, with the small businesses developing, there's a lot of companies doing really good things out there, and there's a lot of great opportunities out there. And EIS provides that perfect wrapper in terms of the fund to be able to deliver a product that's suitable for the advisor world.
Sure, it certainly seems to me that companies that are going to be purposeful are going to be the ones that are going to make money, rather than ones who want to make money might try and add to be purposeful, which has perhaps happened in the past. So EIS really lends itself to that, because it is patient capital. It has to be patient capital. So I think that the two kind of align quite neatly on that. So I think that makes a really good point. I want to break down the kind of the E and S and the G a little bit more, and dive a little bit deeper into that. So perhaps if we start with the E for environment, Max, I'll go to you on this one. When you're talking to companies and looking for them to add them to your portfolio, do you set them kind of, obviously you set them perhaps return KPIs or those kind of things. Do you set them with KPIs on their environmental impact? Would that come into your thinking?
Yeah, and so here I might just separate out what we look at when taking a view on the company's operations versus what we look at when we are looking at the sustainable outcomes that the company is driving. So for our sustainability fund, we're obviously looking for companies that are contributing actively to solutions in the environment and across the other dimensions that I mentioned previously. So what we're looking for there are companies that have clear sustainability outcomes. That could be carbon that is prevented from going into the atmosphere. It could be reduced waste going to landfill. It could be reduced water use. And those key KPIs, those are things that we'd want to see reported regularly against, set out right next to their key financial performance indicators as well. And we do require that companies set targets on those up front, and we will measure their performance against those as well as their financial metrics. Taking a more kind of broad look at the ESG component, where we're talking about the operations of a company. So are they having an impact based on how much their employees are flying to get to meetings, or their energy tariffs, et cetera. Those are conversations that we'll set out with the company upfront. We'll have an assessment of their current profile, and we will work with them to develop a roadmap for improving that profile over our investment horizon. And I think that's kind of the key thing when talking about ESG as applied to the early stages, is that a lot of the frameworks we've talked about just simply aren't fit for the scale of early stage businesses. It's too much to throw at them for a 5 or 10 person team even that are fighting 5 different fires at any given point in time. So you need something that they can work with upfront, and then that you can scale that the maturity of that reporting function along with the business. So we very rarely would look at a business, say, based on your current ESG profile, we wouldn't invest in you. We would rather use that initial assessment as part of a conversation with the management team to understand if there's a willingness to improve that over time, to set targets. And that's usually a pretty good indicator of whether it's a team that has a good vision for the future and also is one that you can work with as an investor.
Sure. Brilliant. Thank you very much. So that covers the E off. Steve, I'll come back to you for the S, if that's all right. So kind of two questions in one here, if I may. What do you do as Growth Invest to encourage diversity at Growth Invest, number one? And similarly, what do you see across the market in terms of EIS funds and SEIS funds and VCT funds trying to doing to try and help encourage diversity in the companies that they work with and invest into?
Yeah, I mean, it's interesting. I mean, we're a small company ourselves. So, it goes back to some of the points already made that, whilst we have our internal policies, etc., in terms of the way we, go about our business, we don't have that great infrastructure that a lot of the big corporates have, where they can instill some of these big policies, the anti-bribery, corruption, etc., etc. So obviously we adhere to that. We have that embedded in the ethics of the company. And I think it's similar across the board when you're looking at these smaller companies that, some of them are four guys working in a garage together that, are coming up, they've got a great idea, they've got a great product or service that they can potentially deliver. But, do they have the governance and the everything in place that they need that a big corporate would have? Well, do they need it day one? They probably don't, because their focus is really delivering value in terms of the business or the service that they're producing. And it's going to come in time. And I think, both Max and Lisa have alluded to this. A lot of it is with a mentoring from the fund managers themselves in terms of nurturing them to the point of it is a startup. We're talking at the very first steps for these companies. So it's all a learning process. It's building it up from the basics of, well, you've got a product, you've got a service, something that can deliver. How do we allow you to grow and scale up, embedded into it, the social side, the governance within the company themselves? So it's tricky because there's not a lot of information out there. So from a framework perspective to model it, it is tough, and I think this is where more work needs to be done, particularly in this space. But the more people can work together on this and we come up with some solutions, the better going forward. And really it's all about educating and bridging the information gap to the advisors such that they can make more informed decisions. So we're all responsible for helping on that aspect.
Sure, and as you say, they're all startups, and in your example, having four guys, I'm sure it's in their kind of roadmap and the kind of future plans, much as EIS and SEI is, to have a diverse board, to have a diverse company, and have all those different elements for bringing together. But that is something that's perhaps further down the road for a lot of these guys and girls. So it's a good point to make. Lisa, I'll let G for you for governance. In terms of the companies that you work with, again, it's super early stage. How much attention do these companies pay to their board? Should they be paying more to it? Kind of what feelings do you get when you speak to companies?
It's a really good question, and I would echo very much what Max and Steve just said about the stage that the companies are at and what they're actually, what are they able to cope with? But also our, and we see the majority of companies we're investing in are 2 or 3 people, have some kind of product, have some kind of customers, but they're really, from a business perspective, it's, the tiny seed of an actual organization. So really our job there is very much to help them. We talk about the journey that the company has to go on, the journey that the founders have to go on, and the journey the organization itself has to go on as it grows, and helping them understand all the different dimensions that they need to keep leveling up in continually. And obviously it's a never-ending process. But on the governance side, often the challenge for really early stage founders is that they are wearing all the hats all at once. So they are the shareholders, they are the directors, they are the managers, and they are the operators, the people actually doing the work. So I think a big part of what we do is help them understand all those different roles individually and understand how they need to start splitting them out into different systems, because ultimately we need, the right discussions, the right decisions, the right strategies to be being implemented and decided on with the right quorums of people. I think that's a big part of governance. What underpins that all working well is that being a diverse enough group of people that are inputting into those decisions. And I think, so touching back on the diversity perspective, as a fund, we are 60% female, 40% male in the fund team. But then looking across at our investees, we have mixed teams in over 20% of our investee companies, which is, you know, a lot higher than the industry average. But from a board perspective, what we're trying to help the companies understand, and I think this is increasingly a more acceptable kind of concept to people. You're not sort of you're not having to educate as much as you probably would have done a few years ago, the need for diversity on boards. But the NED pool that we work with our investee companies is 50-50 male and female. So out of the active NEDs we have in our investee companies, half of them are female. And so it's really helping those founders understand, yes, you've had this concept for a business and a product and a customer and a vision for where you want to go, but there's a lot of maturing operationally you need to do, and here are the good practice ways of doing that, and then supporting them where we can along that journey, sharing lessons from other investee companies, perhaps ones that are a bit further down the line in terms of the scale and the levels of maturity. And setting out that example of, okay, this is the good practice we need to be aiming at from a governance perspective. And obviously they don't always want to hear it, because sometimes it's, you know, writing more papers or doing more accounts or providing more information. But, you know, generally after you get through that little bit of pain of pushing on the next level of embedding good practice, they generally can see the value in what that's delivered.
For sure, and I guess that's the role of a good VC, isn't it? It's telling companies things they perhaps don't like or don't want to hear, and trying to help them go on that journey towards where they want to get to. So I guess that all works for the good in that sense. We talked about companies for the last 10 minutes. Perhaps want to bring it back to advisors and investors as well. So Michael, just a question for you, if I may. For advisors who haven't looked at ESG before, or have looked at it and thought, well, I'm not sure about this stuff, if you are kind of dipping your toe in the water, what advice would you give to them if they're looking at it for the first time?
Yeah, I think it's you know, education, research, you know, is the key area, because I think a lot of financial planners will be familiar with building portfolios, sort of, you know, using different asset classes and geographic styles. But, you know, the difference with ESG is that there's another filter in there, which is, you know, what are the ESG thematics? What are the styles? How do you represent those in your portfolio for your client? And how do you sort of manage the ongoing risk and the integration of those things? So it's sort of knowing where to go in the market to get information. There are specialist companies out there that have devoted quite a lot of time towards trying to sort of bring some clarity to the various names, if you like, you know, sustainable and impact, etc. Where do you go to actually get a fund that represents those styles, and what sectors do they actually represent at the end of the day? So I think definitely getting into that space, matching that up with client requirements at the end of the day, yeah, no, I think it's you know, education, awareness, matching with client circumstances, and risk management. So there's quite a lot of detail in there, and new information. So you know, either take it head on or bring in others to assist.
Yeah, so it's a case of doing the good old CPD and trying to get some more education on this stuff, and just getting information and getting yourself comfortable with what this is all about, really, I guess, by the sound of it.
Yeah, indeed. No, I mean, I think you know, clients there's an increasing interest clearly from a client perspective because of all of the awareness issues out there. You know, I think you know, for older clients as well, I think, you know, you've got millennial and Gen Z kids who are you know, telling them what not to put in the recycling bin, etc. I mean, you know, it really sort of comes from you know, from the living room, I think, as we were saying before, as well as, you know, at the corporate level. So I think, you know, in order to match that, you know, education is the key. Sure,
and it's good to add on question that's just come through there. How does the regulator view all this stuff?
Well, the FCA recently have just sort of announced 5 new principles in the sector, and they're using the sort of clear and unambiguous sort of, you know, rhetoric to make, well, clear and not misunderstood sort of rhetoric in order to you know, to get their points across. So that's all about getting information from clients, and then trying to replicate that in the portfolio structures. The regulation obviously comes at various levels. There's a sort of country, the stewardship codes, which come down from a sort of government level, and the FCA are absolutely focused on it. Obviously MiFID II as well, which is again requesting that information is made clear.
Sure. Brilliant. We're starting to get a couple of questions come through. It's 10:48, so I've got about 12 minutes left, so I might just fire into a couple of these questions. If I may, so one here saying, how should VCTs and EIS funds be reporting on progress on ESG KPIs? If there's no reporting on progress, then how do advisors, investors know what the fund managers are doing and what they say? Max, do you want to take that one?
Sure, and I think that's an important one, and again, it helps the conversation that advisors can have with their investors when understanding what is important for them in these investments beyond just financial returns. So what we tend to focus on for the sustainability fund is reporting those a few key indicators of the sustainable outcomes of an investment, which will vary company to company, and then also providing some of those ESG high-level outputs, which can scale in terms of the detail that's added with the business and with the portfolio over time. The challenge here, again, is I think as the question asker is alluding to, is that there are not currently standards that are used uniformly across the board for fund managers. So that creates quite a complex problem for advisors and investors in understanding, how do we take this fund's ESG reporting and compare it with another fund's. And I think that's something that the industry needs to work towards over the next 5 years, is figure out how are we going to uniformly report so that investors know what they're looking at, know how to compare funds on these metrics, and that data then becomes more tangible and useful.
Sure. So here's a question for you. Should an EIS fund be judged by as much by the return it's giving to investors as to how purposeful it is? I guess the problem there would be how would you have a consistent and sustainable metric to cover that off?
Yeah, I mean, I think this ultimately has to come down to the conversations between advisors and their investors, and ensuring that their values are aligned with who they're backing. We put our thesis out there, and it's for investors to decide whether that fits for them. We obviously believe that our sustainability focus is not at the concession of financial returns, but actually is enhancing it. There are other funds that will clearly state that impact is a priority, and that may be detrimental to the financial returns. I think it all has to start with a conversation with investors, ensure that they're educated and they know what they're investing in, and that aligns with their values.
So I guess it depends on what your definition of success is in that sense. We all think Richard Branson's successful, but if he set out to be a bin man, he's not been very successful. So I guess it depends on what your objective is and how successful we are in meeting that, doesn't it? I guess really. So it's a question here for, I guess, aimed pretty much at you, Steve. So should platforms be reporting ESG metrics as well?
It's an interesting one, because we've had a lot of discussions in house about this, and obviously we act as an independent platform to provide a facility for advisors to execute through us and do the administrative solution for them. I think where we've come to on this is really to start working with some of the third-party independent research houses to come up with this framework. And as I say, a lot of it's collaboration, working across the industry with trade bodies, regulators, fund managers to come up with a framework. And I think Lisa's mentioned as well that it's tough because there's never going to be one framework that fits all. And it's really trying to work out a compromise solution which is adequate enough, that there's enough information for the advisors. So we want to be involved 100% on that, but I don't think we want to lose our independence on that, because all of a sudden, if we start rating firms, then it becomes discretionary in terms of why have you given us this rating against this, and we do, we have an ESG policy, because there's a lot of funds it's not prominent on the fund itself. It's not designed as a sustainability fund, but it could be part of their overarching investment theory and policy in terms of taking into account the PRI, etc. they've signed up but it's not evident there straight away for an advisor or an investor to see. So, really it's all about, and it comes back, it's been mentioned many, many times, it's about education and information and making sure that is available. Whether we can help distribute that information, I'm not convinced we should be the ones that are coming up with the answer to that, but I think we can help towards getting a solution to it.
Sure, sounds like a good plan. So you kind of aggregate all that information and then present it, but not necessarily kind of get the information in the first place, I guess. Really.
Correct,
yeah. Brilliant. Okay, we've got about 7 minutes left. Thank you very much for the questions that have come through. That's been really useful, so thank you very much. Probably time to ask one more question and start to wrap things up. So my question is kind of looking forward a little bit more. We talked about the history of ESG and how it's come from being kind of ethical green, all those good things a few years ago as to where we are now. I just want to ask about where you see the future of ESG and where you think this is all kind of heading towards ultimately. Lisa, perhaps I can go to you first on that one.
Yeah, I mean, I think this is not, as was mentioned before, this is not a fad. This is going to be, fundamental principles that underpin the success of, the valuable businesses of the future. This is clearly the direction of travel from consumer perspective, and all businesses need to care what their customers think and how their customers are making purchasing decisions. From a talent perspective, and from an investment perspective, is clearly, the way things are moving. I think from, we've discussed how this covers such a broad range of topics. And I think that we have there's those different areas have got different levels of maturity at which good practice is defined. Data and reporting is defined. There's particular ways of reporting on carbon usage or on waste. Perhaps some of the other dimensions of ESG are less mature in terms of how well defined they are about what good practice is, how you measure impact, how you report on it. I think, when I look across our portfolio, topics that we are more often helping companies to understand their responsibilities in would be things around diversity and hiring, responsible hiring, employee engagement, employee incentivization, and that whole kind of employee-employer relationship. There's a lot of change happening in what is deemed to be good practice and responsible business. And then similarly, I think when we think about customers, an area that we are seeing change and development is in how companies use data and responsible use of data, whether that's in AI, machine learning and bias, or if it's around customer behavioral data and marketing, and we've seen GDPR come in that's touching on that. But I think that's another area that we'll see increased focus on what does good practice and responsible practice look like, and what are some standardized frameworks around defining good behavior from the not so good behavior. So
less desirable behavior,
so it's not going away. I think we'll see some dimensions catching up with others in terms of the amount of focus that they get.
Sure. And then Michael, how much of this has been kind of accelerated by COVID and the pandemic over the last year?
Oh, well, I think that's certainly changed attitudes and minds a lot. I think it was a bit of a sort of view into the future, given the change of the rate of change that needs to be made, particularly on climate change. It was a bit of a worry in a sense, given that when the whole of industry was closed down for quite a long period of time, emissions were only carbon emissions were probably reduced by around about 40%, something like that, which is basically where we need to get to by 2050. So it was a good view into that, and just a sort of reminder of the serious work that needs to be done in order to get there. But I think, as to the long term, it is a long term, it is a serious business. People, companies and countries are now fully behind that. I think some of the concerns really, I suppose, are the transition process, because we've got to get the fossil fuel industry converted over to renewable energy over a period of time. And if you sort of go back to the 80s, you look at the sort of mining industry, when that closed down, it not only left a lot of people unemployed but unemployable. Whereas I think the transition process this time, I think the government has already sort of committed some money towards this, is making sure that, you know, people in the fossil fuel industries, you know, have a future in the new world as well, and working to make sure that that happens. So I think there are issues, there are valuation issues as well that are sort of floating around in the market. There's a lot of premiums in certain assets which, you know, might not be there, you know, if it wasn't for these incentives. So, you know, clarity there, particularly in the bond market. You know, the pricing in bond market, certainly in the green bond market, has been you know, influenced a lot by the fund flows that are coming in. This is also, you know, something for the future for the sector. I mean, fund flows in the ETF space, fund flows in the European sector have gone ahead of non-ESG. So Q1 this year, European ETFs, ESG fund flows ahead of non-ESG. So that's a major step forward. But all of these risks, you know, the transition, the valuation issues, we're all moving in absolutely the right direction. You know, it's just managing personal risk, if you like, you know, in the outcome.
Sure. And then Max, in terms of kind of pipeline of companies that you see that you would qualify or meet the criteria that you have for your funds, are you seeing enough of them? You're on mute, Max.
Sorry, almost made it through without anybody making that mistake in the last moment. Yes, this is the basic answer. I think we're seeing a lot of really high quality companies who are building solutions to help us through this transition to a more sustainable future across all of the dimensions of sustainability that we've talked about. And I think there are, you know, a few reasons for this. One, you're seeing a lot of new tech talent move from traditional tech, to the extent you can call it that, but from non-sustainability focused tech sectors who maybe have exited an early venture. Maybe they have been working at technology for a while, but want to move towards something with more purpose. But these are people of a caliber that I think have been not missing, but just not as abundant as previously was the case when looking for sustainable ventures. And they're able to attract talent now at a preferential price point, I would say, because they're finding other young people who are interested in having a career that isn't just about creating a financial return, but also something that motivates them to show up. So we're seeing a lot of really great companies, a lot of really motivated teams, and very optimistic about the entrepreneurial ecosystem in the UK and the dedication towards building a sustainable future, and also ensuring that there's a just transition towards that sustainable future.
Perfect. And then final word to you, Steve. Advisors are always looking to diversify their portfolios. How can they add some ESG in an EIS, VCT, SEIS world? How can they add some of that into their portfolios?
Well, I guess we're almost at the perfect storm in the fact that, you know, we've got the demand from the investor, we've got the mandate for the advisors to talk about it with the investor, but also we're getting the supply from the funds themselves. So as we mentioned earlier, we're seeing more funds come into this space in the EIS and CDIS space that have ESG credentials. So, you know, it's out there. I think, you know, go back a few years, it was difficult to find or to really delve in and look at the individual companies to see which ones tick the box for ESG. But now a lot of the work's being done by the due diligence of the fund managers themselves to come up with targeted funds. So from the advisor perspective, you know, it's great. It gives them something to talk about with their investors in terms of ESG is here. It's here to stay. We've said it's not a fad. You know, it's all about legacy really, and people investing not just for the future, but for future generations as well.
I guess it's a nice thing to talk about with your investors as well. You're talking about good, powerful, purple, impactful things.
Given some of the difficult and bad things that, you know, you have to discuss, it is a really nice area to talk about. And people, you know, are investing for returns, but you're investing for returns and actually doing something good along the way. Yeah, it ticks the boxes.
Absolutely. Good place to end. Thank you very much. I promised to get you all away by 11 o'clock, so epic fail from me, apologies, but only because we had such great content from all our panelists. So thank you to all our panelists for their content and contribution today. It's been a fantastic one. If you did miss it, if you're clicking in late, if you didn't see this one, you can catch it on a recording on our website. That'll be up in the next couple of days or so, so pick it up there. Again, if you missed day 1 and day 2, you can pick those up as well. Don't forget, of course, there's free membership to ESA. Just go on the website as a financial planner. You can join us for free and you get all these webinars and much, much more besides. as well. So as I say, just thank you to our panelists. We're back again tomorrow, so please do join us again at 10 o'clock for our webinar. Then otherwise, just leaves me to say thank you very much to all our panelists and goodbye.
Brilliant. Thank you very much.
Thank you.
Thanks.
Bye.